In fact, the underperformance of Nifty 50 is so stark that a new generation index has delivered an astonishing 63x return over the past 19 years, compared to just 16x of the Nifty 50. In other words, 1 lakh invested in this new generation index would have grown to 63 lakhs, while the same investment in Nifty 50 would have only reached 15.5 lakhs. That's a staggering 47.5 lakhs of missed wealth just because you stuck to Nifty 50 investing. Imagine how much more financial goals you could have achieved if you had invested in these alternative funds. This is another startling slide that disappoints those who trusted investing in Nifty 50 or funds based on Nifty 50. We will discuss why this happened and what are the alternatives. If you take the past 6 months, performance of the Nifty 50 index, this fund has performed the worst compared to other index. The difference between it and the best is a whopping 4.4% per annum. So if you look at the underperformance for the past 1 year, Nifty 50 has underperformed the best index by 9%. 2-year comparison, Nifty 50 is poorer in performance compared to the best performer by 6% per year. Across all time horizons, Nifty 50 has underperformed other indices by a good 1% to 4% per year, although over longer time the gap reduces. We will discuss the alternative funds, but first let's explain why Nifty 50 has been underperforming. I would like to present this research by Balaji Vaidyanathan. Nifty 50 is an aging index. 60% of its stocks have not changed in the last 10 years. So it is dominated by companies that are stable, but they are not innovative or they are not high growth. The top 10 companies in the Nifty 50 have an average age of 62 years. And we live in a world of disruption. So being stuck with the older, less dynamic companies is a disadvantage of Nifty 50. The Nifty 50 also has a very high concentration on financials. 33% of its weight is in this sector. That's one of the highest in the world. The growth in banks business is beginning to plateau because people already are having multiple bank accounts and other financial products. So there is not as much room for these big banks to grow further. Plus, there is a rise of alternative financial products like mutual funds, insurance companies, AMCs, depositories. So the scarcity value that these banks once had is also disappearing. This has limited their ability to perform well in recent times. In the IT sector, the larger Nifty companies are struggling against the rapidly growing smaller firms, impacting their growth prospects. Consumer goods companies in the index are trading at a very high valuation today, which typically leads to lower future returns. Additionally, the automotive sector is experiencing huge disruption from new players who are entering the market, and this is increasing the competition, and this could erode further market share of the established companies. Overall, these sectoral issues are hindering Nifty 50's ability to deliver a strong performance. A lot of large cap growth is happening outside the Nifty 50. Unlisted multinational tech giants' Indian operations are growing at a faster rate than the Nifty 50 companies. These companies are achieving sales growth of around 40% per year compared to a mere 9 to 10% of the Nifty 50. This shows that the real growth is coming from outside the traditional index. The bottom line, investors, they can either stick with Nifty 50, which seems safe but is underperforming, or they can explore new gen options such as factor-based indices or mid-cap, small-cap stocks where there's more potential for growth. His writing concludes saying, just like in Mahabharata, where Arjuna's choice of Lord Krishna over the larger army led to his victory, investors need to make smarter, less obvious choices to see better results. So what are the better choices and the new gen options? I will share a few points for your consideration as part of your further research. Please keep in mind that this is not a recommendation, but a knowledge sharing exercise and starting point for your own investigation. These indices focus on specific characteristics such as say price trends, sentiments, or fundamental ratios. There are single factor based index such as momentum based, quality based, low volatility, growth based, or value based. The index based on momentum and quality have shown dominant outperformance over the long term. So there are single factor based indices and then there are multi-factor indexes such as these. They combine two such factors such as quality and momentum, value and momentum, low quality plus momentum. Their trailing returns along with the risk measured as standard deviation are here. You can pause and watch this video. I can provide the detailed presentation on the momentum plus quality index. If you would like to receive it, just send me an email here. These may be fairly new and the historic performance is charted based on backtesting. Some of them look very impressive, needing further research. The factor-based indices also go through different performance tilts. For example, momentum-based index has been the top two contributors in the Nifty 500's performance, but they have also had worst year of performance. Quality factor has been on the top for some time and then at the bottom. So there is an index that combines these two factors, momentum and quality dual factor index. This index boasts of consistent performance in the last 10 years and it has done that with a lower drawdown. You can see that here, and their performance is better than the Nifty 500 and even the other single factor indexes. Not only that, their maximum drawdown, that is the maximum loss of the portfolio from the peak, it was 31%, much better than that of Nifty 500, which was 38%. It is also better than other indices. Then there are smart beta investment options. I have done a detailed video on Nifty 200 Alpha 30 index. If you have not watched it, please do watch it here. I have also done a video on Nifty Top 10 Equal Weight Index and you can watch it here. This space is constantly evolving and staying informed is key to adapting with the times. So keep a close watch. You can benefit from the potential outperformance beyond the traditional Nifty 50 benchmark. And if you're only investing in Nifty 50, you cannot ignore the growth potential in the mid-cap and the small-cap stocks, as many of these companies are more dynamic and more innovative compared to their large-cap counterparts. This chart shows how the market cap of the mid-cap has grown in the past 5 years, from 12% to 17%. The small-cap segment has also grown considerably in the past 5 years. At the same time, the large cap has shrunk from 82 to 71% in the last 5 years, showing a steady loss of market cap. Even the Nifty Total Market Index has beaten the Nifty 50 across most time horizons. Historically, these stocks have outperformed large cap over the long term, especially during economic recoveries. Investing in these stocks can lead to higher returns, but it's important to note that they also come with higher volatility and market risks. Market sentiments can affect these stocks more dramatically, leading to larger price corrections. Hope you enjoyed the content of this video. If so, please consider liking this video, subscribing to this channel, and sharing it with your friends. You'll also enjoy watching this video, which covers a very different, equally intriguing topic here, and this one here with similar insights.